Care Bear countdown. 3, 2. Does your kids like Care Bears, Amar?
Nope. We actually don't have a TV.
Why? That's what I'm talking about. You don't have a TV?
Yeah, we're since 2009 we don't have a TV. So I used to work in New York City, and how they do it there is like the building has one provider. So like we're living in this building and it only had Verizon as a provider. And when they have a monopoly on that building, they charge a lot. And I was like, I'm not paying that much for internet or TV. And we cut the cord since 2009.
So do you have no, not like what, the Roku things or whatever they're called?
No, we don't have Roku. I mean, we have Netflix on the laptop, but
so
that's about it.
Like, so what do you, like, if they want to watch TV, they just watch Netflix on the laptop?
Well, they don't want to watch TV because they've never watched. I mean, like, we go to grandma's house.
What? They were quiet for the last 3 hours. No. Hey, they were literally quiet, laying down for the last 3 hours, and suddenly they jump up. Would you stop? Dude, that's fantastic.
Hey, Josh, I'm going to share my screen so we can have the disclosure on the.
Did I tell you, TV is a. Go ahead. The TV is it's just brutal, man. That's fantastic. I didn't have a TV growing up, man, and that's one of the reasons I think I'm so inquisitive, because I read a lot, because we had no TV. We literally had no TV at all, and as such, you had to find other creative things to do to keep your to keep yourself occupied. You know what I'm saying?
Yeah, and I think like jobs in the future. I mean, now knowledge is. You can just Google stuff, right? And so creativity is going to be increasingly large percentage of future jobs, at least in the U.S.
Dogs. Harry said dogs want to watch TV.
There you go.
Let me add the disclosure here. I think that's right. Actually, I was talking to a guy the other day. I said, man, I can't remember what it was. We're just talking about. I said, don't overlook the creative issues, because creativity is robots and AI can't take over human creativity. That's for sure. You know what I'm saying? So. All right, so everybody, don't forget to subscribe to Amar's channel at Client First Cap Learning on YouTube. So subscribe if you haven't yet, please. Jill said she only had rabbit ears and small black and white growing up. Harry says I use over-the-air antenna himself. Yeah, right on. We got Alan San Diego with us. Jeremy Rhodes is here from Maine. The interesting thing is we had a tiny black and white quasar. Was it 8 inches or something like that? And I remember, I didn't know the Incredible Hulk was green because it was black and white, so you couldn't tell they was green. You know what I'm saying? That's how old I am, Amar. I'm an old man, crusty old man.
So
go ahead.
These disclosures here are basically saying everything is for educational purposes. Yeah. We haven't considered your specific situation. We're just here to give you some content so you can think about and come up with your own conclusions. If you need help, you can reach out to Josh and I, and we'll be happy to help. I think, why don't we just jump into it?
Yeah, right on. All right. So you want to start?
Yeah. Let me start with a question so we can see how many caregivers will there be in the United States that are unpaid? So this is like a family member or somebody else that would be helping in the millions. What number? So maybe I give some choices. What do you think, Josh?
Yeah. Can we do a poll? Can we do a poll where people can answer?
I don't know. Okay. This is your technology.
I know on Zoom you could, but I don't know how to do it here. But yeah, all right. No,
we'll have to figure that out. So it's just for the time being in the United States.
Yep.
How many millions of people are giving care and they're unpaid? So I'm going to just start with some numbers. 10 million, 20 million, 30 million, or 40 million.
Wow.
What do we think?
So I guess it's got to be over 3 million, huh?
Yeah, it's going to be over 3 million.
So 10, 20, 30, 40. So A, B, C, or D. I'm going to say This guy said 50. I assume 50 million or lady. So I'm going to say C. Yeah. All right. Got a couple 20s. I'm going to say C, which is 30 million.
It's not 30 million. There were 41 million people giving care for a family member unpaid in 2015. And that's why long-term care, not insurance per se, but just having a plan around needing help is so important. And I always remember two things that I remember about long-term care. Number one is personal experience through my father, but also I had one of my clients who was Army. It wasn't a Ranger, but he was in the Army, and he said this: if you don't die, you grow old. Yeah. If you grow old, you tend to need more help, and having a plan for that help is what long-term care is all about. And so
just on that. So real quick, is that just for old people, or is it for, like, you are a long-term care provider right now for your children, are you not? So how's that?
No. These are people that need care. The average age of the caregiver was 49 and a half or 49.2, and the average age of the recipient was 69.4.
Wow, that's
through the survey through Morningstar. Yeah. Mm-hmm. So we're talking about people that need help. And the other thing that we should point out is that it's disproportionately caregivers who are female tend to give care. And when we think about this from a planning perspective, but also a legacy perspective, is that if you don't have a plan in place, then you're affecting different chains of your family, right? Like, it could be your spouse, it could be the next generation. I have one client where one of their grandchild is he's paying his grandchild to help him out, and you know, this is why I think long-term care is so important. It's not that you should buy insurance; it's that you should have a plan in place. You know, most people will self-insure. I think that the average cost, I have it in here. I'll have to look it up, and we'll do that in our next poll. Yeah. But so real quick.
Go ahead.
Yeah. So disclosures, again, educational purposes.
Oh wait, I got to bring it back up. There you go. All right, cool. Good. Right. We're good. But I think just real quick, I think Jeremy makes a good point. It's the female nature to nurture. I completely agree with that inherently much. In fact, and then real quick, Amar, folks, always remember, long-term care is about caring versus curing. Always, you put that in your head. Long-term care is caring. Going to the hospital outpatient, that's curing. We're talking about caring, and that's where it gets can be very expensive and long, lengthy too. All right, go ahead, Mark.
Yeah. So and I want to make sure that we cover some of the things around the cost too, and maybe we'll do that at the end of the slide. But here, just like Josh said, right? It's this middle sentence here is that, you know, Medicare, Medicaid will not cover most of the expenses associated with care. And sometimes it's not the care that you're thinking about. It's, you know, getting out of bed, changing your clothes. There's these things called daily activity, ADLs, activities of daily living. Includes like pooping, brushing your teeth, putting your clothes on, able to eat, walk. There's one more that I'm missing. Getting out of bed, I think, is
transferring. That's one I know.
Transferring, yeah. So most insurance companies say that if you can't do 2 out of the 6, then that's a qualifying for a long-term care event.
Yep.
And if you don't have a plan, then you're just going to be spending down your assets. And then after you spend down your assets, then you're actually looking at, one of the state-run type facilities and
Medicaid. Yeah.
Medicaid, yeah, and the facilities that are run by these, you know, some of them you have to have a certain percentage that are Medicaid, and the rest is private pay. You know, so they get subsidies and whatnot. But I would highly suggest take a tour of some of these facilities and say, like, is this where I would want to be? Is this where I would want my spouse to be? And it is something that will become an emotional decision. It could be stress, stress around that. So a couple things, Josh, you want to add anything before I pull up some questions here?
Well, I was just going to say, just remember, you can still have a plan for long-term care without buying long-term care insurance. I just want to be very clear on that. Long-term care insurance is not the only plan for long-term care. A lot of times, long-term care is you do self-insure. I mean, that's fine. There's nothing inherently wrong with that. We're going to talk about some insurance products here today for those of you who are interested, because the market has changed so much. Because Nancy says, I'd like to consider it, but I'm not sure. It might be too late for her. I don't know. Oh, no one knows. But I'm just telling you right now, as you get older, it becomes prohibitively expensive for long-term care insurance the traditional way. But there are other ways to skin this cat. And for most people, just self-insure. That means just pay out of pocket. It's okay. But
have a plan to pay out of pocket. Like, I work with clients the average age is 73, 74. And their parents grew up through the Depression era. And even if they have the money, it's hard to spend that money on care, right? And so so that's something to be cognizant of. One thing I was saying,
Amar, and Denise, she says she took off work for 3 months once and 1 month another time to take care of her dad. So they're going back to your initial thing. The second time was 1 month because he passed away. I watched him from the time I got up until the time I went to bed.
It's hard. I mean, that's got to be, it's got to be very difficult. I mean, and so when we're talking about the cost of care and stuff, so 63% of people estimated who are 65 today will have little to no out-of-pocket expense, right? But 40% or 37% will. And I just want to give you some numbers here. So the estimated median annual nursing home costs for a private room in 2030 is estimated to be $142,000 a year. I mean, that's a lot, right? So a lot of people or a lot of individuals will have to look at shared rooms, or I think the more people I talk to is that they want to stay in place. They want to stay in their own home. And so having care come to your house part-time or full-time can range from between $19,240 and $51,000 a year. And that's what, what we're talking about is how are you going to cover that expense? So
it's $250 a day for a live-in aide here in New York, says condo guy.
Yeah, I mean, it's expensive. And a lot of times, one of the things that I've heard, children will get care or figure out a plan. Jeremy says move in with your grown-up children.
No.
Sometimes your children are just about to retire, and they're at the edge of their seats, looking at this freedom of retirement and to be able to do all the things that they haven't been able to do. And so there's this really says if you're not going to self-insure, there's basically 3 types of care that you can purchase, right? There's long-term care insurance, right? Just the traditional vanilla long-term care insurance. There's a hybrid long-term care policy through an annuity policy that will give you income and a rider that would pay for some care. And then there's also life insurance policies with long-term care riders built into them. Now, we don't really cover the life insurance with long-term care riders a lot because it is expensive. Inherently, you have 2 big costs there. You have the cost of life insurance and you have the cost of care. And they're going in opposite directions, right? So the longer you live, the long-term care cost goes up, but the need for care cost goes down. Yeah. And I guess there's this arc, and this arc peaks at the time that you probably need either one of those the most, and it becomes really expensive. So I think the biggest benefit to some of these life insurance with long-term care policies is if you already have a permanent insurance policy, and you can 1035 or 1031 exchange it into another policy that has one of these riders in them. So it seems to be a good thing. So what's
Well,
it?
here's Harry. He's paying $1,000 between for just both a year. If you have an older policy, I just tell you these older policies are freaking worth their weight in gold because they underpriced them. Now they're doing the exact opposite. Now they're overpricing them. So
it's like and the insurance company is like a pendulum, right? They swing. Yeah. They went from way underpricing to way overpricing. One of the problems is like they don't want to have bad press, right? And so it's hard for them to kind of change some of these older policies.
You have that. You want to do the example of the thing, or you got another? What do you got now? I can't remember if we're going to do the example next, or okay? There.
No, let's go through the slides, and there's a area where we can.
All right, man. You just tell me when the slides are done. We'll bring up the example exactly.
So picking the right coverage, right? So most important is to figure out what type of coverage you need, right? Somebody that's in California doesn't need the same policy that somebody that's in Texas, because even the state has different things that they would co-cover. So in California, if you had a long-term care policy, they had this California rider that you could get that it would cover that much in assets before the state would step in. And so there's different riders. It's kind of like auto insurance, right? There's different bells and whistles. Yeah. You have to figure out which ones apply to you, which ones that you want. One of the ones that is your premiums, right? So do you pay annually? Do you pay monthly? Do you pay quarterly like Harry? Sometimes there's a break in cost if you pay annually, right? Sometimes some of these policies have a lump sum where you can pay all up front and then not have any subsequent payments. It also matters that like what your health is, right? It's kind of like life insurance where you can get table rated, meaning the higher likelihood of claim, the higher premium that you would have to pay. Same thing is true with long-term care, but it's in the opposite direction. If they think that you're going to live a long time, then you're going to have more. There's going to be more inherent costs there.
If you see me laughing tomorrow, I'm not laughing at you. I'm laughing at my dogs because they are nuts. But yeah, just so don't think, why is he smiling? It might say something stupid. It has nothing to do with you. These guys are nuts.
Yeah. Focus, Danielson. Anyway, so sometimes with long-term care, if you have an annuity and you can take payments from your annuity directly to your long-term care provider, you can avoid some of the gains in the annuity being taxed, right? So these are things that you want to consider. The only other thing that I could think of that we didn't cover in here is inflation protection.
Yeah, man.
So there's two different types of inflation protection. There's simple and then there's compound.
Yep.
Simple, let's say you have a 3% inflation protection, it's 3% off of your base amount. So if it's let's say $100 a day, and then next year it's 103. The year after that, it's going to be 106. So that 3% is based off of the base amount. Yeah. Compounding says, what is your benefit at the time, and then adds the inflation on top of that. And sometimes, like the devil's in the details, some of these inflation protections, it's pegged to either CPI or they give you just a max. Yeah. Right. So like you get a stated amount, like 3%, 4%, whatever you put in your policy. Sometimes I've seen as high as 5%, but
like here's one. Jill's got this one right here. Hasn't moved a penny in premiums, but 3% per year compounded. You're never going to see this kind of policy again. So I mean, those compounding policies and with inflation, those things are expensive. Which is why they know the insurance companies aren't stupid. They know there's a risk, they know there's a demand, and they know that their policies are expensive. That's why they offer these other policies. There's other options. Yeah, keep going, Amar.
Well, I guess the problem has become, because it's become so expensive, traditional long-term care is there's not that many providers anymore. In what would you say, like 2005, there was at least 20.
Something like that, yeah, it's crazy.
And then now it's down to maybe 2 or 3 that are underwriting vanilla traditional long-term care policies, because the actuarial tables were greatly mispriced.
Big time, yeah.
So what we're left with is a hybrid long-term care policy. So this is taking like another insurance product and adding a rider to it to make it have a long-term care benefit. And I think
it's army knife of insurance products, essentially.
Yeah, and Josh, when we were first starting, Lincoln Money Guard was like the product that kind of pioneered.
Yes, love the Lincoln Money Guard. Absolutely, yeah. I sold some Amar. I sold some Lincoln Money Guards, as a matter of fact.
Yeah. And so basically, these policies work in a traditional way, in the sense that there's the annuity product or life insurance product, whatever it is. And then there's a long-term care rider that will give you a multiple of either income or death benefit amount that you can use for long-term care expenses and not have a penalty or a taxable event. Some of these are included, like, why don't we just go through the example now?
Oh, absolutely. Amar, so one of the reasons I like these hybrid policies is because, like a condo guy says, his mom paid $370 a month just before she died, and she never got to use it because she chose a 6-month elimination period. So remember, Medicare essentially covers you for like 100 days, I think, Amar, and then after that, you're on your own. So basically, it's 90 day, a 3-month elimination period that a Medicare will cover. Essentially, is kind of the rule of thumb. So in this case, condo guy's mom self-insured for 3 months, so Medicare paid for 3, she paid for 3, and then she died and never got to use it. So what happens is she paid a boatload of money into the policy and she never got anything for it. Now,
I wonder, did she get a return of premium or anything like that? Maybe the condo guy can say that.
Well, that's a good question. So condo guy, see if she got her money back, because what happens is here, especially with that kind of premium, I bet she did, but I don't know. But he'll answer, I imagine. But Amar, what happens is, well, you know this, is that you pay all this money in, you die, you don't use it, and all that money was lost. Now, before people start screaming bloody murder, that's like saying, I wish my house would have burned down so I could use my homeowner's insurance policy. You know what I'm saying? It's the exact same thing. That's what insurance is there to protect against catastrophes. But insurance companies aren't stupid. No, she didn't get that offer, he said, Amar. New York, they live in New York. The hybrid policies, yeah, if you want to bring that up, I think should I remove this? You have it up there, the
Yeah, let me bring that up. But before we bring that up,
okay, go ahead.
I would just say that the average age of people looking at long-term care, let's take a guess at this.
Yeah, there you go.
We're going to say 50, 55. Well, no, let me do this in 2.5-year increments. So 50.
Oh, no, do 5-year increments. It's easier.
Well, the number is an exact number. Okay. That's engineering me. So, all right, so we're going to do 55, 57.5, 60, 62.5. Right? There's 4 options there.
I'm saying 62.5. That's what I'm saying. So I could go down on the record saying 62.5. I don't know that to be true. Amar has not shared these numbers with me yet. So Jeremy says 55. Jeremy's a youngster. So for Jeremy, 62.5 is like freaking, Grandpa Jones, even though I'm 50 right now. Anybody else? So what do y'all think? So,
all right.
Let's keep letting a couple more go. Jennifer says 57.5. Jill says 48. That wasn't the question. Jill, we didn't ask when you got your policy. Pay attention. Directions, Jill, directions. 57.5 says Scott. Harry says 40. Jimmy says 57. All right. So what's
so Jimmy is right. Jimmy and Big E from Texas.
Wow.
So 50%, 48% of all long-term care solutions are bought between the ages of 55 and 64. And 57.7 is the average age of a long-term care insurance policy purchase.
Oh, that's a purchase, though. That's not when the people start looking.
No, this is when I said, when do people purchase their long-term care?
I thought you said when do people start looking. Okay, gotcha.
No, they start looking. Yeah, so I mean.
So I guess I wasn't paying attention. Is that what you're saying?
Yeah. Anyway, so of these policies, right, the number of hybrid life long-term care or policies in 2018 was 461,000, meaning a large percentage of people are now defaulting to this hybrid policy. So let's pull up one of these policies.
Yeah. All right. Want me to bring it up?
It should be there you go.
Cool.
Did you want to go through these policies?
Yeah, absolutely. So let me just start with did you ever sell any Lincoln Money Guard when you were a young broker, a young whippersnapper?
I was purely in investments.
Okay.
This insurance thing is last decade?
No, right on. Well, exactly. But I mean, there's some sweet commissions in them. That's for doggone sure. And remember, a lot of the salespeople get 65% of first year premium. Just I don't know. I'm sure that's still the case. Now they got these ones now, like Amar. He does it it's a fee based policy, and he can explain how that works if you ever want to talk to Amar about this. But a lot of these insurance guys, the reason they got these freaking houses on the water is because they make a lot of money in commissions, man. It's 65% of first year premiums. Anyway, so when I sold Lincoln Money Guard, I had a couple just both retiring from Merck in Elkton, Virginia. And this is the first one I ever sold. And they each dropped in $50,000 Amar. So I think they're both in the mid 50s. They both put in $50,000. They had like I just remember it's 50,000, 166,000 for long-term care benefit and 212,000 for a death benefit. So basically they could get the 50,000 back at any time and cancel the policy. They could use long-term care for like 166,000 if they ever needed the long-term care. And if they died, they get 212,000 back to their estate. So it's pretty sweet, man. It's like you knew that you're going to get your money back from one way or the other. By long-term care, by death benefit, or by just getting your money back because you don't need it after all. So that was pretty good. So let's go into this. So this is oh man, I wish hard for me to see this. All right, so go down to the next. Yeah, go down to the next one, Amar, would you? Shoot. I'm gonna have to. I can't see that. Let me bring up.
Why don't you share it on your screen?
Yeah, so exactly. I was right on. So let me bring up. Hold on. I'm gonna share on my screen 100%.
And while we're doing that, Nancy, where is it? Yeah. So what age can't you afford to purchase care? I mean, the care just gets more expensive. And so that depends on everybody's situation. One of the things, again, we want to reiterate is that you don't have to buy care. You can also have a plan to, what you want to see happen and kind of self-insure some of that, because at a certain point, the cost of getting insurance may be way too expensive. And that point is, depending on your personal situation, right? It's what could be expensive for one person may not be for somebody else.
And along those lines, I have long-term care, as I told you guys a million times a Sunday, for the old ball and chain and me. We both have long-term care from Knights of Columbus. It's a fraternal Catholic organization. And the reason we have it, and I think I bought when I was 40 and the old ball and chain was 36. The reason we got it is because there is a significant sizable population of people under the age of 65 who need long-term care. And as such, if something were to happen to me, mentally, and Charlotte couldn't take care of me, not only would my income be gone, but she have to put me someplace. And she'd be broke, man. She'd be broke. So I bought it, and that's a traditional long-term care policy, which I have. But it does get more expensive as I get older. That's for doggone sure. All right, so I'm going to share this, Amar. This is going to be the North American one. All right, so can you hold on a second? I want to see if
we can see your screen.
All right, sweet. So this is fantastic. All right, so this one I was looking at, and I don't know who Samus Financial is. I got no issues with saying I got no knowledge of these people at all. And you can see us tomorrow?
Yep.
All right, sweet. All right, so what I want to do is I want to go into as the problem is with any kind of life insurance product is you got all of these product terms and stuff like that. And what we're going to do is we're going to come down here first and foremost, and we're just going to all right. Wait, is this long? Was this this was the annuity, valued annuitant. This wasn't a long-term care thing. This is a flexible deferred annuity contract. So I pulled up the wrong one. This is your annuity contract, Amar. That's actually pretty good. I didn't mind this at all. Was there a reason you wanted to show this right here? Because this was actually pretty interesting to me. I thought we might talk about this, but was this something separate you wanted to talk about?
No.
I didn't say long-term care provision in this though. So let me pull up the other one. So I'm not sure. Okay. Well, here, I'll stop sharing that one. I'll pull up the other one then. That was actually a pretty interesting product. Your indexed annuity product that maybe we'll talk about. Maybe it might not be able to talk about today, but maybe at a later date. Let me cancel this real quick. All right, let me bring up the other one. Are you did you have a chance to? Why'd you get that illustration on the annuity?
Oh, that does have a long-term care multiplier on it.
Oh, the annuity did? I didn't see. Okay, yeah. Interesting. I see that. All right, but let's pull this one up then. Interesting. Because that actually looked pretty good, and I thought you might have sent that to me because I did a couple of videos on protecting the downside, and here's some ways to do that. On another video, we're going to get in deep into Amar's ability to do some put options and things of that nature, and other ways to protect. Maybe we should just do that next week, Amar. Just go into strategies to protect the downside. I'm actually even more concerned about a downside issue than we have. I'm more concerned about that right now than I was in a long time, frankly. Anyway, so maybe we can talk about that, and we can do that next week instead. Would that work for you, you think?
Sure. Yeah, let's.
All right, here we go.
We can talk about it
offline. You don't want to talk about with everybody watching. All right, so here we go. So we got a lifetime income plus multiplier flex. All right, so first, yeah, okay, I guess the same thing. All right, that's interesting. So fixed index annuity illustration prepared for the value client. All right, so again, this is just a sample. We're not going to go too deep into this. But what I want to show you here is I want to go down to, look, and if you buy this product, you can sit on the boat with the sun out there. Isn't that cool? They're never sitting there digging ditches when they buy these products, right? All right. So what we're going to do is we're going to go down to the, right here. All right. This is what we want. Can you see that? Let me see if I can't make this bigger. All right. There we go. All right. So this is Arizona, non-qualified, which means it's non-IRA money. All right. And so what's happening here is we have every single illustration is going to have a guaranteed amount. All right. So every single illustration say this is what we guarantee. So you always got to start with that. Then they're going to have all these different up here interest crediting strategies, point to point with spread on PIMCO, point to point with a Merrill Lynch, just all kinds of different spreads. I don't even want to get in that here today because it's way too there's too much to figure out. But we're going to say we have cap rate, that's participation rate, 100%, the cap rate, participation rate, cap rates. These are all the terminologies you got to understand. So we're going to go into this. Guaranteed retirement income. All right. So they're going to say, so we got a bunch of different things going on. It's a Swiss Army knife. Now, a Swiss Army knife in of itself isn't looked on as a bad thing. But sometimes when you're the jack of all the trades, you're the master of none. And that's not necessarily a bad thing, but just keep that in mind. If you're comparing a product that has a lot of different Swiss Army knife components to it, you can't say, well, that product sucks compared to this specific product, if that makes sense. You can't say that Swiss Army knife is bad because this one product that's geared towards chopping down wood is better. That's true. But the Swiss Army knife has a saw, but it's not the same as a freaking chainsaw. You just got to keep that in mind. And I think a lot of people, they like to do comparison like, oh, that's too many options, and neither option is the best in the business. All right. So anyway, so in this case, we're putting in $300,000 is what we're dumping in here. Okay, so $300,000 is going to take it out as an income for life. And the guarantee here is they're saying if you wait until you're how old here? You're 65 years old, you'll be guaranteed to take $14,400 out. That's one guarantee. If you wait until you're 80 years old, you'll take $20,000 out. That's another guarantee. That's the worst case scenario based on the claims of paying ability of the insurance company. So what I do with that guarantee, I take my trusty calculator. Now, this is a guarantee for an income perspective, not necessarily a long-term care perspective. And we'll look into the long-term care provision here in a second. $14,400 divided by $300,000. That's going to be a 4.8% guaranteed payout, which in of itself isn't great, but it's actually not bad. That's not bad. Now, it's a 65-year-old person. It's going to be on one life. So we don't really want to do that because we could find other ways to get that a little bit better. But at the end of the day, going back to the Swiss Army analogy, that's actually not bad. That if you say, look, I don't think I'm going to need this for long-term care. I just need it for an income perspective. You're not getting rooked here from the annuity perspective, if that makes sense. It's not bad. It's not great, but given all the other bells and whistles that are in there, it's not bad. So that's the worst case scenario. So we're going to go down here, and we're going to see other illustrations. We got a hypothetical right here. And what's going to happen here is they're going to use their various index, what they got on the indexing on PIMCO, the Morgan, the Merrill Lynch, all these other things as well. And we're going to see that's, if I could show this, that's hard for me to see. I need my glasses. I'm getting old, Amar. But you'll see that in this case, you actually made some money in this year right here, the year two. All right, you made some money. You made some money. You made some money. Now, these are not guaranteed, but at the end of the time you're 80 years old, given that you made some money, you have $470,000 that is worth your contract value. It's neither good nor bad. It's just what it was. All right, so $470,000. Now, if you were to take an income stream off that would give you right there $48,000. So remember, with a guarantee, we're only getting a guarantee of at 80 years old. We go up here. We're saying we're getting a guarantee of $20,000. Not great. But it's not bad. However, in this case, if the markets did anything, and it might not, we don't know, but we know for a fact we're going to get no less than $30,000 a year. In this case, we got right there a guaranteed minimum with these market projections of $48,000 a year. So we have a floor of $30,000, and we'll say an upside of $48,000. That's not too shabby, and that's with all fees and everything. Now, all right, so let's keep going down here, and this is where it gets real crazy because all these interest, crediting, accumulation, value details. Look, at the end of the day, you recognize you're if you're buying these kind of products, the insurance company's making money. There's no other way around that. You're going to pay fees. I just cannot stress. You're not getting around that stuff. You're not going to be an S&P 500 index on the upside, but we're also going to have guaranteed protection on the down, which I like. I mean, that may or may not be good for you. It might not need it. I don't know. But all right, let's see. So let's keep going down to the long-term care stuff. Hold on just a second. And this is where it gets, let me just, we're going to go to long-term care. See, I didn't see the provisions on the long-term care stuff here, Mar. I just saw these were the income, but I didn't see anything on the long-term care. You sure?
Yeah, and so I just got this earlier today. Right. So I haven't had a chance to look at it, but it does have what it's called like a multiplier on the need of care. So I think how they, in this illustration, what they show is on the last column, the legacy component, the death benefit, that is how much you have access to. You can pull from that amount if you have a care event.
All right, so let's look. So you're saying this right here, the legacy death benefit. Yeah. Okay, so it's accelerated. Oh, all right, I see what you're saying. But okay, so let me look up the accelerated death benefit. All right. Accelerated. Okay, that's it. I don't like that. They don't. I'm not a fan of that if we're using it for long-term care. It's not very explicit, and I need it to be explicit. So what you're saying here is you got. I don't like that, man.
Let's just go back to our presentation.
Yeah, I'm not a fan of that at all. So I thought you were using that for an annuity because I said that's pretty good, but I don't like that. So real quick. Accelerated death benefit, my friends, is what that means is if you need if 2 of the 6 ADLs, the assisted daily living, if you can't do 2 of the 6, and the big one's transferring, literally getting up and rotating 90 degrees is transferring. If you can't do that, get them off the toilet. That's literally what it is. You can't get up off the chair. You can't get off the toilet. If you can't feed yourself, if you can't, just 6 activities of daily living, what Amar was saying. If you can't do 2 of those 6, you get access to that death benefit to some degree for long-term care. Now, I didn't see anything in either of those illustrations that said how much. So I'm hesitant to go down that road for this seminar. But My issue is the accelerated death benefit is a way you have access to your life insurance component without dying, which is kind of cool, man, because I got a $300,000 death benefit. I know in this case, I got $300,000 as a guaranteed minimum death benefit. A lot of times the accelerated death benefit, I get about 66% of that, essentially is what it is. So if I have a $300,000 death benefit, that's a life insurance component of the annuity or the life insurance. If I'm approved for 2 of the 6 ADLs that I can't do, I can tap into that accelerated death benefit, the death benefit, and take money out to protect me for long-term care before I die, if that makes sense. The drawback about these policies, there's so many bells and whistles, it's hard to follow through and understand what's going on. I mean, I looked at that. I looked at the first one. I said, I didn't say anything for long-term care. Don't get me wrong, Amar. That's the issue with these policies. They're confusing. However, you can't let the confusion sway you from saying, I can't ever do that because I don't understand it, because it could be some significant value there. Don't forget, secondly on that, there is a value added that you have an income stream that you can't outlive. And it's just a fact. Now, would I do that right now? No. I'm 50 years old. I'm accumulating into my portfolio. So I'm all VTI or bust. If I'm 65 years old, though, and I can't qualify for traditional long-term care policy because they're doggone expensive, and I have some money sitting on the side that I don't quite know what to do with, I'm nervous about the stock market, something like this is not a bad idea. It's not, because then you can cover income stream, potential for a little bit of upside growth, and potential for long-term care all in one. Neither is going to be the best benefit, but all three is a pretty good choice. Yeah, so you were saying, Amar, you want to bring back up that presentation?
Yeah, let's do that. And to your point, 37% of people that applied for long-term care between the ages of 65 and 69 were declined coverage.
Yeah, as long as you get more too, absolutely.
Yeah, so
the hard part I had when I sold my MoneyGuard policies, which is similar to this, what you just saw right there, but it didn't have an income guarantee like what these policies are doing. The hard part I had was that, all right, sweet, brought it back up, was they had to qualify for life insurance and they had to qualify for long-term care simultaneously. And remember, the insurance company risk to life insurance is that you die too soon. You die too soon. The insurance company risk to long-term care is that you live too long. And this is where these hybrids come a challenge and why they're not as great as some insurance purveyors would make it seem. Because if you die too fast on a life insurance policy, the insurance company's on the hook. They'll never make their money back. On a long-term care, if you live too long, the insurance company's on the hook because they'll never make their money back. And so they have two literally competing entities there with life insurance and long-term care contract. It is, Nancy. I might want to bring that back up. Marty, just
let's do it later.
Well, I want maybe when you're off, I'll bring it up and just kind of go over the annuity aspect of it, because I think there's some benefits there. But anyway, yeah, keep going. Let's keep going.
Vinyl Earthlink basically said you should buy an annuity that pays at age 85. Well, yeah, that's what a QLAC is, right? So a QLAC is a qualified longevity annuity, which you can basically defer required minimum distributions to a later time period and then take extra income at that point. So that could work for that as well. So the last thing here, I mean, we'll end it on the last few slides. So you already talked about the life insurance with the rider, competing goals. So just be careful. And then there's a couple questions around costs. So a 60, if you apply as a couple, it's actually sometimes can be cheaper than if you apply independently. And so if you take a couple that's 60 years old, it's about $3,500. And for $150 a day benefit. And if you take a single 55-year-old male, it'd be about $1,800, and single 55-year-old female would be about $3,000.
No, that's discrimination, man.
Well, there's factors that influence the policy, and there's also different types of bells and whistles you can buy, but state that you buy the policy in, the health at the time that you buy the policy, and the time that you get it. And so another thing that I have here, I just went over that. So the benefits are both for all of these policies about $165,000.
All right, so let's ask a question. Is the insurance company discriminating against women by charging almost about 60% more? Is that discriminatory? So let's ask a question to the audience here. Is the insurance company hate women because they're charging that much more? All right, so say yes, the insurance company hates women, or say no, they don't. Let's see what we got. We need some engagement, my friends. Engagement helps the algorithm. So let's see what we got here, Amar. So thanks, Amar, for the cost factors. All right, so I'm saying the insurance company hates women because they charge more. That's what I'm going to say. So I'm speaking on behalf of everybody. That's right on. So the two ladies are out there. They know. The insurance company does not hate women. They're basing it on life expectancy. Exactly right, Denise. And that's the issue. The insurance company says, oh boy. I'm going to get rid of this guy. We got a guy we got to put in timeout. We got to block him because women live longer. That's 100% right. So it's shocking, but it's kind of like the pay gap. Insurance companies do like financially naive customers. That's true. Exactly. But that's not because women are financially naive. It's because women actually live a whole lot longer. In fact, what's the life expectancy for men has gone down to like 76 now. Now that's the baby being born today, but still women live longer than men. It's just a fact, man. Claudia says, we live longer. Oh, that's discriminatory, Claudia. That's just straight up wrong thing. All right. So what else we got on this here, Amar?
Nope, we're just open to questions now. All
right. So let's go back. Amar had a personal experience with long-term care himself. Now, did you say, Amar, that your pops had it, the long-term care?
Yeah, so my dad got a hip replacement surgery, and he ended up getting a blood clot during the surgery that then gave him a stroke. And so his recovery process from the hip